Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over some comments. I'm going to answer some of the questions that you guys put in the comment section. I try to get back to everyone and at least share what my financial opinion is. It says, hey Andy, I'm a little confused as to how ETFs or producer prices react to uranium spot price. Say uranium goes to 100, reflecting about a 3x from here. How do the ETFs react to that? Do they also go up 3x? Do they go up more or less? So really, the question is, do the mining companies of uranium go up more or less than the spot price? And right now, this is going to be a pretty big question for commodities in general. This is going to be applied to any commodity. And this is why you get leverage with a mining company, but it doesn't mean it will always work out that way. There's always risk in mining companies. And that's why I hold a large physical metals position, because it's the lowest risk. You get a direct relationship to the price move, and you have no risk, counterparty risk. There's no risk of nationalization, projects going wrong, cost overruns, etc., etc. But generally, I'm just speaking in general. A commodity company, and what they do is they have a cost to produce it. If a company is a producer or a developer, there's a couple of things that a mining company can do to add value to a shareholder. So the first step, this is a big question. For any of the commodity companies, is you have three types. You've got explorers, developers, and producers. As you work your way up from an explorer to a developer to a producer, that progress adds value to the shareholder. So what you're going to notice is if you were to price a uranium company on a dollars per pound basis of a company, so you take their market cap is their total valuation in the stock market. The market cap is the outstanding shares times the share price. That is the market cap. If you were to divide it by how many pounds in the ground they have, what is their reserves, and you get a number. That number is going to be very low for an explorer because one, they're exploring and most of them don't have anything. So value is created in an explorer from going from a piece of land to a whole bunch of pounds in the ground. And what their duty and what their job is to basically mature whatever land they have into a deposit that is quantifiable with some certainty. So they have a finding and they create it into a deposit. They've got, I believe it's inferred, indicated, and then proven, I think. I might be mixing these up because I go through them so fast. And they're trying to prove up those reserves and add value to shareholders through the definition that they put on that finding. They're defining how big it is, the size of it, the concentration of it. So that's value on an exploration company. The developer has a deposit, and they're progressing it towards a producing mine. They're making that deposit into a mine, and they're going to mine it somehow. And there's multiple techniques to do that in uranium. There's the in situ recovery process, ISR, is what people talk about. There's just open pit, and there may even be more than that. I may not know every single little method that there is to mine a deposit, but they're going to be priced higher. There's going to be more value there in terms of dollars per pound in the ground than an exploration company. The exploration company goes from zero to a massive finding. You know, if they find something, their valuation pops way up. They're gonna add a lot of value to shareholders. That's the fun part for most people, is the find. The developers are developing and they're adding value to a producer, and then the producers are valued the most because they're the closest of. They're basically a company that churns out uranium out of the ground and sells it at spot price, which there's a large difference between some of these companies. There's a large difference between what they cost to produce it or mine it and what they can sell it for. Now, what you're looking for is leverage to the price of uranium. And where they get the leverage is those three spots. And then if you have a high cost producer, and I'm just going to make up numbers here, the spot price is at $30 a pound. And let's say a uranium producer produces at $32 a pound. So they're losing money if they were to go into production. So right now they're not in production. They don't want to be in production. But let's say the spot price takes off. The spot price takes off. These guys are way in the ground. They're not priced very favorably because they can't make any money. Their deposit is deemed not valuable because it would be a losing deposit at current prices. Now, let's say they are a developer. They're going to develop the mine. They're very close to production. 3 years down the road, 4 years down the road, uranium goes up substantially. It's at $100 per pound. And let's say their costs, I'm going to make this easier. Their costs are $30 a pound. We went from 30 to 100 on uranium. That is a $70 increase in the price of uranium. But if you're at 30 and you're making zero money as a producer and you go to 100, well, now you're making $70 per pound, but you were making nothing before. That's your leverage. If you don't make anything, and I don't know what that necessarily would equate to, it would probably be thousands of percents gains, many thousands, because your denominator, you can't divide by zero because they weren't making any money before. And that's where your multiples come. And it depends what the market thought of that company at that time. Is it something that is, sold way off? They don't think they could make money? Or is it something that was highly valued that they thought they had a good chance of making a bunch of money and people were bullish on uranium prices? The time to buy a lot of these companies is when you're below the cost curves, which we are, and people don't want it, with a ratio that's very low. And what that ratio is indicating is, and when I say ratio, I'm talking about uranium to gold. Gold is an accounting measure for how much money is in the system. And then I price it against gold because that's your accounting mechanism. That's what basically takes inflation out of the game. It takes it out of the calculation. And when you're at that very low ratio, it means that the money's not there. That's how you're getting the low ratio. There's no money in the uranium sector at the moment in comparison to other sectors. And what happens is when things change over time and people look at things through a different paradigm, they look at assets differently given certain market conditions, and money starts to flow and rotate around. There's a lot of money in the system and it sloshes all over the place. But when people take a favorable view of uranium, whenever that may be, money's going to come into this sector and that ratio is going to move. Historically, that ratio bottoms more at like a 5 or 6 to 1 ratio or lower even. And that doesn't mean that gold's at its peak price. It just means that is where it basically peaks out against gold, wherever gold is at that moment. If gold goes to $10,000 an ounce, maybe gold at that time is only $3,000 when it peaks. Gold usually peaks after all this, the energy sectors, and commodity boom kind of happens. And maybe it won't. Maybe it continues to take off. But the companies, since we're looking at earnings per share, has massive leverage to the price of uranium itself. And when you don't make any money in the beginning and you try to divide by a very small amount, you get a many multiple expansion. It could be 1,000 times your money, 1,000 times, literally. There are some companies. Now that's very difficult to do. You'd have to be buying when no one was buying that company. But I think it's possible to see some 50 baggers or 100 baggers, 50 times your money, 100 times your money. So the mining companies will return more than the uranium price itself. And last cycle, I heard there was some, even like the worst uranium producers, like the ones that, maybe not the worst, but the most unfavorable uranium producers were returning something like 20 times your money. The best was over 1,000. So that's a very good probability, I think, of finding a couple of these companies and really getting a massive return on it. Are we all the way at the bottom? We're probably not at bottoms. So those returns could be more like 5 times or 10 times from where we are today. And some other ones that are really good, maybe we have a 100 bagger or 1,000 bagger in there. If a small exploration company hits it big with a very easy to mine deposit and really proves up a bunch of reserves, it's possible to get 1,000 bagger out of one of them. Possible. I'm not saying it's likely. It's possible. So that can be applied to any of the commodities sector. I do think uranium, where it's priced today, is one of the best opportunities still, given all of the areas. I still like oil. I still like uranium. I still like copper. I don't think a lot of copper companies have moved that much. I like the royalty companies quite a bit because you get all the leverage and none of the risk. I just like that model so much. It may not pay off as much as an exploration company, but I think your risk reward is pretty good. So risk-adjusted returns in a royalty company, I think, are excellent. And the reason I think they're excellent, because if you're talking about returns and you want to look at certain things to invest in, royalty companies are a diversified approach with leverage to the price of uranium or gold or silver or copper or nickel or whatever you're looking at. What they have is they have royalties on a whole bunch of different mines from different mining companies. They could have 50, 100. They could have a whole bunch, and they get a certain percentage of whatever's produced. What is produced is based off of volume and price. So they get it off of volume or price for the majority of these royalties that they set up. It's basically like a 1 or 2 or 3% net smelter return. They do have other ones where they negotiate a certain price. They can buy it at a certain price given that they gave a loan in the beginning. Or most of them are net smelter returns, and that's what you get in return is a certain percentage of production. And when they grow and when they prove up reserves, whatever companies this is in, those reserves grow for the royalty company as well. So that's also a very good thing as reserves grow. I do like uranium royalty company. I'm sure that's a good one if you want to look into it. If you're looking in the uranium sector, I'm putting some money into it. I do think it's a good way to have a leveraged, diversified, lower risk approach that gets you a lot of leverage to the upside. So risk-adjusted returns, I think, are pretty good in Uranium Royalty Corp. UROY is the ticker symbol. And again, this is not financial advice. You guys have to do your own due diligence. I'm just giving you guys options to think about if you're new to the uranium game or new to the investing game. The royalty companies I like in general just because of that diversification model. You get a whole bunch of different royalties from a whole bunch of different mining companies. Now you don't have all your eggs in one basket. You don't have all your eggs in one mine or one deposit. Some of these bigger companies have multiple deposits, which lowers your risk. But what happens if you're in a country and something happens to the country? And let's say you've got all your eggs in an African, let's say it's Namibia and something happens there. And then all those companies go away. It's like, ugh, God, you're just getting smoked if you have all your money in the African, countries. And if it's Namibia, there's a lot in Namibia. I'm not saying anything about Namibia. I'm just saying if something were to happen, and you're only in all these Namibian, companies, something could happen. It's risk. So that's kind of my take on the uranium. They're much more leveraged. If uranium goes up 3x, these things could go up 30 times, 50 times, 60 times, 100 times, 1,000 times. It all depends on the company, where they are in the process, and how they're adding value to the shareholders. Here is, it says, I think the choice of the Fed is clear. Raise rates and cause a complete deflationary collapse. Politically and socially not viable, or kill the dollar. Also, real estate is not the driver of inflation we are now seeing, but rather the result of massive increases in the money supply by the Fed. Correlation does not necessarily mean causation. How does higher home prices raise the cost of food or cars? Well, I would say it's a very easy thing to think about. You see what a lot of people do is they take something, and then they take the primary driver of something, and they say, well, this is correlated here. There's a whole bunch of other tertiary effects that go 1,000-fold deep. It's kind of like the government. The government creates a job, and they say, hey, look, I created a job. Well, where'd you get the money for that government job? Well, you took it from society, right? You had to take it from a value adder in society. I'll put it this way, all right? Dollars don't create anything, right? Dollars create nothing. Everything in society is created by people who add value to society. Something of utility to society. A product, a natural resource, that's really it. We can't all service ourselves indefinitely. You have to eventually go to a product or a natural resource at some point, period. You can't have a computer without a natural resource, and you have to have some sort of product to sell. So you can't service computers indefinitely. You can't service other people indefinitely. You have to, at some point, you need a product, you need something that has value. All the money in the system just steals value from those products and from the products and natural resources that are produced by those who produce that value. Everything else is stolen. All of the financial world is just middlemen taking something from the value creators. That's all it is. Because that's all you have of value above ground. It's either a natural resource or a product. That's it. Everything else is stolen. So anything that drives dollars higher, doesn't matter what it is. Now, the thing that I've noticed is that the M2 money supply goes up when we're in expansionary phases of real estate. Now, they sent checks out. They literally sent checks out, and that is also inflationary. I agree with you there. But historically, when you watch the M2 money supply in an expansion phase of real estate, they've all gone up. We've never had a deflation in an expansion phase of real estate. Never. That means it's expansionary. It is expanding. We have new loans against new homes, which expands the M2 money supply. That is where that expansion comes from. If the M2 money supply goes up, that money goes somewhere. It seeks out something. Now, if all value in the world comes from a natural resource or a product, that's it. You can convert. This is like the most simplest thing that I can explain, all right? Natural resources, and if it's a product, what do you think the companies in this world, if they're value-created companies, they convert this natural resource into a product. Now, there's some things that can create efficiency in doing so. That's what your software is. You can put software things in whatever, but in reality, that's kind of like almost a service. It's like you're creating something that may have the product more, it may function more efficiently or add more value. So it is a value adder, and it is created kind of by nothing. Maybe. But let's just go back to natural resources and products, which is natural resources converted or configured in a way that people can use them. Food is a natural resource, and it's consumed by humans. If the money supply goes up, that is inflationary. And where does all that inflation go to? Natural resources and products. It eventually goes down and goes into those things. Now, inflation just raises the price of everything. That's it. So, therefore, if the inflation comes from the real estate expansionary phase, it therefore increases food prices. Just maybe not directly in a way that you can link this all together. But if food prices only go up under inflationary times, or when there's massive shortages, because that's the supply demand, but I'm going to take the supply demand out. If all food prices only go up when we have inflationary periods, therefore, if inflationary periods are caused by an expansion of the money supply, and if the expansion of money supply is caused by the expansionary phase of real estate, one would conclude with certainty that real estate causes food prices to go higher because of the direct connection to inflation. So yes, it does cause food prices to go up on a overall general arching basis. Now, you can have disruptions in different sectors where some things go up more than others. And that would also be a supply-demand problem, and that money doesn't slosh around equally. It moves all over the place. But on the long term, yes, it increases the price of everything. Says, no, you may have mentioned in a previous video, but what would be the expected returns of market caps of companies in the sector to reach for uranium? Well, it all depends on how high the uranium price goes and how everything turns out. I mean, I would expect some of these to go up 30 times, 40 times, 50 times, 60 times. Some of them are going to go up that big. And they're going to be probably the smaller companies, it's not going to be a Camco. It's not going to, well, I don't know what next gen's going to go up, but it all depends. I think market caps could be in the billions for a lot of these small, $100 million market caps could go into the billions. Yep. And that would be a pretty big return from where we are today. It says, Andy, how can institutional investors participate in buying these stocks if they are not above the $5 mark? They will be soon. A lot of them will be above the $5 mark. They're going to go up quite a bit. It says also, for what it's worth, one YouTuber says the decarbonization is the factor that will give this uranium bull market some legs, in that this has to go for a long time to replace fossil fuels that run most of our industry and transportation. I would say that decarbonization is a factor, but it's not the biggest factor. I would say the biggest factor, in my opinion, for the uranium bull market is the fact that we don't have a bunch of inventory coming from decommissioned missiles like we did before. And when that inventory's gone, now you're just left with price to balance everything out. And if the mines take a long time to basically develop into a producing mine, if you're 3, 4, 5, 6 years away or longer, where's this new supply going to come from? I mean, this is going to be a very weird dynamic. Now, what they're speculating on is the demand side. What I'm telling you is our demand, it can go up. It's the supply side that can't respond very quickly. That's the factor that I think is big. It's the supply side, not the demand side. I mean, someone could find a deposit and they'd be like, hey, look, we got this huge deposit. We just found it. Well, how long does it take to get it into production? 10, 15 years? Well, what are we going to do in between? I mean, what if there's a huge gap between what they're doing 10 years from now and today, and we don't have a ton of uranium coming online in between those two dates? And I don't know the full dynamics here. I'm not saying I understand all of the dynamics, and I don't know if anyone necessarily does, but what I am telling you is the supply side isn't as responsive as what most people, I think, are thinking. They just think this stuff comes out of the ground and it's just here. It's a lot harder than that. And some of it, people don't want mines in their backyard. They do not want that. So I think decarbonization is hardly any factor. It's the supply side that could be a huge factor. And I think copper's got that same dynamic going on. I don't think they can just yank this stuff out of the ground. I don't think it's like, hey, look, there's $20 billion mine just bam, popped in their backyard here. Nobody wants it. And if prices are going through the roof, what do you think these countries are going to do? They're going to be like, oh, that's ours. We're not going to sell that. We're not going to give it to some private company and have them make all the money off of it. You're going to see nationalization, is my guess. So now what you're looking at is, well, maybe I should start buying physical precious metals. Get it in my possession. Get it out of the system. Reduce that third-party risk. Reduce all my risk. And that's one aspect that I do. What if their input costs go through the roof? What if, and remember, royalty companies, they are, I would say they're immune from input costs. They don't have those costs, volume and price. So if your input costs go way up in some of the mining companies, their margins get shrink down. They get tight, but then the price is going to continue to go up because you're going to need those prices to continue up if the input costs all go up. Royalty companies are going to kill it. They are going to kill it. So I'm accumulating the royalty companies and just holding on, and physical metals. And then obviously I have some mining companies too, obviously. Swing for the fences, why not? But remember, guys, this is just my opinion. You guys can disagree, and that's fine with me. But I'm just sharing my financial opinion here. Says, thanks for the content. I share channel on Wall Street Bets group on Gab. Go ahead, share my videos. Thank you for doing that, Liberty Keg. Here we go. Do you know anything about NEWP? I don't know anything about that. That company. It says, what about the third scenario? It says, we have inflation and lots of it. Rates attempt to go higher. The Fed says we apply the tourniquet now to stop the hemorrhaging and worry about the rest later. The dollar will have to be temporarily sacrificed. The Fed applies rate caps. Michael Burry and Kathy Wood are both right. Commodities, Bitcoin, and technology all shoot through the roof. Pension funds get absolutely slaughtered, but members of the senior population will be able to save their retirements by selling their hugely profitable houses. Interest rates stay low and downsizing. The part that I struggle with is everyone thinks that they can just turn on and turn off these things. I don't think it's like trying to control a really fast dog. And like, you've got it in control in the beginning, right? You've got it in this small little area. You can kind of control it. But the dog's, let's say, twice or three times as fast as you. So this thing, when it's out, it can run like 40 miles an hour, and all you can run is like 20 at best, maybe 15. All right, something like that. When it loses the containment, when they lose control, and this dog gets out, there's no way you can get it. It's gone. It's like the only way you're going to get it is if the dog wants to be caught, like it tires out, or it just says, screw it, I want to go back and sleep in my pen or something. You can't catch it. So my viewpoint is, when the paradigm shifts, so it's like, oh, we're going to sacrifice the dollar. Well, what happens if everyone at the same time, myself and everyone on the channel and everyone in this world, says, all right, they're sacrificing the dollar, I'm getting the heck out of the dollar. What if we all do that? You think they can stop that move? I mean, some people maybe think they can, but what if they can't? What if I say, here's a few $100,000. Go get me precious metals. My neighbor does the same thing. My neighbor does the same thing over here. We're all dumping hundreds of thousands of dollars at certain things. And that money starts rotating. I take another loan out and buy another house. I take another loan out and buy another house. I'm creating money left and right. Why? Because we have massive inflation. I can pay these homes back no problem because of all the massive inflation. And everyone starts doing this. Now, what are they going to do? Not raise rates? Try to slow us from doing this? I don't know. The problem here is everybody thinks that they're thinking very linearly. It's not like a exponential move where, everything's coming up slow, and then all of a sudden, bam, it just changes, and everything it's changed in a month. It's just different. The world changed. Our dollar isn't worth much. People get scared. People don't even ask the question, why am I spending it? I just know this thing's tanking. I'm getting the heck out of it. It's an emotional response. I mean, it's just like Bitcoin. Bitcoin is, everyone's chasing the price. There's no value there, at least in my opinion. And again, you guys can disagree, but they're just chasing price. They're chasing something. The same thing can happen when people get scared. So I don't I don't think they can have high rates of inflation, very high rates of inflation, and people not get scared. There was a lot of people scared in the late 70s, in 1980 as well, when interest rates went way up. What stopped it was demographics. That's really what stopped it. The housing market turned over, the baby boomers stopped buying a bunch of homes, and it slowed down. And interest rates does slow that money as well. So I don't know how they can keep rates super low and have high rates of inflation. I mean, people they're gonna be spending like heck. And what you're gonna see is you're gonna see inflation pop up here, and not a lot of people have seen that in their life. And I'd like to see how people how they respond to it. I mean, I'm kind of prepared for it already. I am. Think of it this way, all right? And I'm just throwing ideas out, guys. You don't have to take what I'm saying at face value. Just listen to it, let it settle in, make it, and form your own opinion. You don't have to agree with me. But what's going to happen is people are they're gonna sit down and they're gonna figure things out. And this is my approach, and just my approach. Okay, it doesn't mean it's right. I am prepared for an inflationary outcome because of the inflation that we're seeing, and because of what I've seen in history with real estate expansionary phases and inflation. I think an inflationary period's coming. I think we're coming to an end of a 40-year decline in interest rates. This is, again, my opinion. Doesn't mean it's going to be an outcome. I prepare myself for inflation, and let's say inflation never happens. What happens to me? Nothing. I took something that was at 100-year lows, I bought it at 100-year lows, and nothing happened. So I walk away, and I didn't really go down much. I didn't lose much money. I maybe lost some opportunity value. And I walk away and I continue to make money. I continue to work, and nothing really happens in my life. Now, let's say I didn't prepare for the inflation outcome and massive inflation comes. What does my life look like at that point? Well, now I've lost a lot of purchasing power, and I'm basically, my lifestyle got smoked to the downside. I would have been better off taking an inflationary standpoint. Now, if I'm positioned the way I am today, and when inflation comes, I'm in the green, baby. I mean, I'm like living the high life. And if inflation doesn't come, I'm living the same lifestyle I have today. There's basically no downside to the position of taking the inflation side. If you don't take the inflation side and you don't prepare for it, if it does come, then you can lose big, and you're positioned incorrectly, and you've lost a lot of purchasing power. So if the inflation never comes, I don't lose anything really. If the inflation comes, I win big. That's the form of a that's the outcome of an asymmetric bet. Is there's not much downside, but there's a whole bunch of upside. Now, if there's no inflation and some of these tech companies take off, then that could be a potential outcome as well. I just don't see how I don't see how they're going to stop inflation. It hasn't happened in history. Once this inflation ball gets rolling, I think it's going to continue. And again, guys, this is just a whole bunch of my opinion. I just don't know how they're going to stop it if they don't raise rates. That's what they've used in history. So if they can, they're going to lie about it. They're going to lower the CPI numbers. They're going to do all that stuff. That's just a given. But I just don't think they can do it for too long. Andy, what was the wall of worry like for you in the last commodity bull market? What was the noise? I know you mentioned you traded in out. So here's the difficult spot with the last bull market is I entered it kind of midway. It was already underway. And I was kind of trading in and out. I didn't know what I was doing. All right. I did not know what I was doing. I did not know anything about ratios. I did not know about a lot of things. I was new to technical trading. I was new to a lot of things. Again, at that time frame, I just graduated college. I graduated college in 2004. That was in the middle of the bull market. The bull market started in 99 and lasted to 2008. And I saw that last blow off top, and it was insane how much some of these companies went up. I mean, Chesapeake Energy and Ultra Petroleum, I saw those two just fling. I mean, they were like massive moves. And I was like, man, I wanted to know what to do, but I was lost. I was lost. And I would imagine getting in at 1999, you'd have to move. I mean, some of these went sideways for a good couple years. So you're going to have to basically position yourself and then wait. And they were at very low levels. Chesapeake Energy was, maybe it was at $5 or something. It was very low. And it went all the way up to, I don't know, 60 something bucks, $80, something like that. Whatever it was. But you had to be sitting in there waiting. And that's a very short time frame. I mean, 9 years and you get 50 or 60 times your money, 30 times your money, something like that. In all those companies, Ultra Petroleum did the same thing. Now, we are early in this bull market. We are very, very early. And we may go sideways for a year in some of them. We very well could. But I know it's cheap. And we're breaking these big patterns everywhere. So the confluence, the data that supports this is very compelling to me. And what I am doing is I'm looking and I'm trying to, I don't want to take the short-term approach. I want to make the big money. The big money. The 30 baggers, the 40 baggers, the 50 baggers if I can get them. And I'm buying low. When the ratios were telling me to buy, I was like, buy it. Buy it because it's cheap, it's down, people don't want this stuff. And what happens is markets don't go straight up. They go up, they consolidate. They come back a little bit, they come back up, and they consolidate. They come back up, they consolidate, and then they just blow. They do a huge blow off top. Now, if you're up 10 times your money before the blow off top, and the blow off top does another 10x, you could have like a 100 bagger that you're sitting on. 100 times your money. 100 times $1,000 bucks. $100,000. I'll take it. I'll take it. Now, what if you've got 100 or 200,000 or 300 or 400 or 500,000 riding on this? And let's say your average, let's say you 10x your entire portfolio or 20x your entire portfolio with that you've got riding and your high risk stuff. Well, now you're making a lot of money. It's a good bet. And remember, I do the physical metal trading too, and that's a lower risk swap bet. So you got to balance your risk. You can't just go all in one thing or bust. I mean, I wouldn't do that. I would choose an approach that you can diversify out. And maybe some of these tech companies are good companies to go into where their S curves are really massive, like solar. I've been trying to get some money into solar. I'll even go into other technology companies. I'm not saying that all tech is bad, but in general, if interest rates go up, the PE ratios contract. And especially with the bigger tech companies that are in more mature areas. I just don't think they're going to be good bets. But some of these smaller ones that are coming up in some new technology, you're going to see some massive moves. I think they're going to be faster and bigger than we've ever seen before in some of these technology companies. We just have to find them when they're young. That's the difficult part. And they grow so fast, so quick that there's opportunities there. I do agree with that technology and the S curve and how fast it can be adopted. And remember, information's traveling so fast these days that things are changing rapidly and people can figure out what products are good and what are bad instantly. So there's all this stuff going on. Is it time to buy silver? If so, or if it's so bullish, I'm waiting for some of these precious metals. I'd like to see a bottom and a turn higher. I'm slow to enter. Right now, what I see as opportunities that look pretty strong and are strengthening, uranium's looking really good. I also think that oil's kind of pulled back. Some of the oil companies may look pretty good here at some point over the next couple months as well, or even sooner than that, like a couple days. Natural gas is interesting because it looks like we are close to breaking the pattern from 2009. But there's an even bigger pattern with tops in 2005 and 2008 that is going to be insane when potentially break that down the road. Natural gas is a highly leveraged commodity. I saw natural gas last bull market with Chesapeake and Ultra Petroleum. Ooh, man, I want to catch some of these, and I'm in them. I'm in them this time. I took some of my higher leveraged companies and put a good amount in it, and I'm ready for this. I've got my Crew Energy, I've got my SM Energy, I've got Centennial Development, Centennial Resource Development, I've got the Callon Petroleum, I've got Grand Tierra, I've got Contango Oil and Gas, I've got my Tetra Technologies, which is a highly leveraged energy service company. It's one of the most leveraged ones, and I went for it. I'm swinging for the fence, guys. I'm going for it. I'm not telling you guys to swing for the fences, but with some of my money, a small, purposefully allocated amount, less than 5% of my total portfolio, which is 20% of my net worth, that portfolio size. So it's 5% of 20%. And that's where I'm swinging for the fences. And I've got my uranium guys too. And I've got royalty companies. Like I am positioned for a commodity boom. I don't know if it's going to happen this second, but it looks favorable. And given the market conditions and given where commodity booms have always happened in an expansionary phase of real estate, I think it's coming. And this is going to transform my life, hopefully, for the better. We'll see if it happens. And if it doesn't, well, I'm going to stay the course that I'm doing right now, keep saving, and keep piling money into what I think are good asymmetric bets. Thanks for listening for this, guys. This is kind of a long one. I just want to go through a lot of your comments, give you my opinion. It's kind of uranium based in the beginning, but that's good. If you guys like this content, give me a thumbs up, subscribe to the channel if you haven't subscribed yet. Don't know what you're waiting for. And thank you for listening. This is Finding Value.